Hi, hello friends. Welcome everyone to Nifty Banker 2.0, India's first retail index traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul and also the host for today's program. It's a great pleasure to invite every one of you into Nifty Banker 2.0. I am sure by the end of this program, you will have a lot of knowledge which can help you to make better decisions in your trading life. Let me thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website. They helped us to reach a wider audience in a short span of time. And let's also thank and appreciate our title sponsor Espresso, the Sharekhan company, one of the leading discount brokers in India. The speaker for today is Mr. Rohit Srivastava, who is the founder and author of IndiaCharts.com. He is an industry veteran with an expertise in technical analysis. He has been charting in the stock markets ever since 1990. It's close to 31 years now. I think many of you are not even 30 years of age by now. He is an expert in the knowledge of Elliott wave analysis. He comes up with models that map the cycles of both stocks and economy. He is going to train us on an interesting topic. The title of today's topic is, are we in a bull market or a bubble? Mr. Rohit, it's a great pleasure to have you on board as a speaker. On behalf of Traders Gurukul, Money Control Pro, Espresso, I extend my warm welcome into this program as an elite speaker. Go ahead, sir. The stage is yours.
Thank you, Ashok, for this opportunity and a second time coming with your annual breakthrough session. And at a very interesting juncture too. So when you asked me for the topic and I was thinking, what should we really do? And this is the one question that has come back at me again and again and again over the last 1 year. Are we in a bull market or a bubble? And it's been a tough one to go around explaining, and especially the reasoning. I think the reasoning that I'll take people through hopefully will throw a lot of light on why they need to look at whatever has happened since March of 2020 differently and try and understand that context, because it's an important context, takes you into history, and especially on days like today. For example, we've not only come out of what was a 2 month long correction. So when I actually thought of this topic, I thought, we were going one way up into October, and then we suddenly got this sell off. So it makes it all the more interesting because after this sell off, a lot of people sort of gave up on the potential that the market could even continue higher and that everything would just be a bounce and you sell into it. And all of a sudden, you have a 2000 point rally again. And even in that, the last 2 days, just as we hit into options, I call it the option settlement expiry sell-off, because every time we come into this final week when stock options specifically are going to go into delivery settlement, there's always a rollover effect, right? Because people will not carry trades into next week. From Friday onwards, the brokers start calling you up for margins if you're in the money on the options. And even if you're at the money, they don't want to take the risk of it expiring in the money. So sort of over the next next week, entire people sort of have give up on all their positions. And so a lot of the booking ends up happening now itself, and many times you see a market reaction. So I'm not looking at this most recent 2 day debacle as anything more than that, even though a lot of people have assigned it to what is rising interest rates in the US, when interest rates have actually not really gone up. It's just the bond market that is indicating higher rates as of now. But you haven't really had any rate hikes officially. But that's how markets are. They try to discount whatever is happening ahead of themselves, and that makes the life of the analyst a little more difficult because he has to think ahead of what the street is also thinking. And so that's where we are in this overall setup. I know a lot of people, especially those who are traders, and since we are calling this the traders conference, would be very concerned with the last few days market movement.
Yeah.
And let me tell you that even when these market moves occur, it also concerns me. So it's not that we don't get worried and we don't have to think back on every aspect of our model, every factor that we are tracking. But eventually we have to come back with an answer, which is, are things still going as expected or not? And so far, I think despite all the intraday worries that even I had, end of the day, the conclusion is the same. We remain in what is a bullish market, and I would not step far away from calling it a bull market. So, why is it a bull market and not a bubble? And what could really change that? I think that's what we'll try and figure out over the next 1.5 hour. For people with very short-term concerns, if I just switch over to a live chart from the binge platform, which I'm finding very very easy to use. We are looking at the Nifty. It's sort of broken out, and when we actually broke out, you look at something like this. When you break out of something like this, okay, this sort of an expanding triangle pattern typically seen in fourth waves based on the Elliott wave structure. But even if you're a classical technical analyst, if you look at something like this, what any classic text really tells you is that you measure the size of this entire pattern. Okay, so if this is the size of the box, okay, you measure it and then you simply put it out. This is classic John Magee. If anybody's heard, John Magee is the classic text on technicals written in the 1960s. Technical analysis of stock trends by John Magee. And the size of any pattern is used to project. And if I use that projection, it would have ended up pointing right to close to very much the 18,600 top that we made in October. So sort of once we broke out of this, it was a clear indication of getting there. Apart from saying that, we got very, very oversold at 16,400. So that was sort of the minimum setup. But where people will be more concerned is the big picture view, which we'll get into. Why should this rally not be over? Why should there be more upside? And that I think should become more apparent as we go along. So one of the things which ended up happening, if I actually move to a quarterly chart, is that this decline that we're actually seeing out here ended up going all the way back. I'm going to use the 40-day exponential average because this is what I usually end up plotting on all my charts. And we ended up actually going back to this level. This level has been visited, I would say, for the nth time in many years. So I'm quickly switching to the chart of the Sensex. Sometimes has more data. And the last time we actually touched this level, not only in say 1992-3, we touched it again. We broke it mildly for a short period we touched it in 1998. Then again we touched it in year 2000. 2008, after this 2009 sell-off, the 2009 bottom was at the 40 quarter average, and then once again we reached that quickly in the pandemic. So it was a long period where we trailed above it, and then we quickly reached that. So it reached a point where we'd seen the market bottom many times in the past, and so it was an important level to start thinking as to whether the next move was going to be counter trend or not going to be counter trend. And once we've actually done that, as the trend started to unfold, it slowly became apparent that this was not going to be a counter trend move. How did it become apparent? I could answer that question in Elliott wave terms, but what I'll answer it now in is a very, very different context, okay, which will also then give us the real answer as to why we could be in a bubble or not, and why we should consider the potential of a bull market that can unfold over many years. So let's now get back to the presentation. We can always come back to that chart, okay, and understand why it looked like that and why this trend can have many more extensions on the upside, even though We are on the lookout for a potential, correction at each point of time. Are you going to get that bigger retracement? Why is this going on one way? And will you get that at all? So I think it's time to step into the answers. And some of those answers are found in what has been a very, very old theory, developed and thrown away into the waters, except by a few people who continue to track it. The amazing thing is that if you pick up any serious technical book, a lot of people today read technical analysis mostly through YouTube videos and online posts. So they really don't end up reading a text hardcore. But if you do, you'll be surprised that most of the key texts, for example, that by John Murphy or by Martin Pring, all have a chapter or at least a couple of pages dedicated to explaining that there's something like the quantitative cycle that lasts over 50 years or something like that, and repeats itself. And then beyond that, there's no more detailed study as to how to measure it, what are the key factors, and how do you really go into this whole thing. And why it's relevant is that once you understand Elliott wave analysis, which is nothing but a fractal of the market. Okay, it's a fractal where when we say the word fractal, what we mean is that if the overall trend of the market is up, okay, then that entire upward move subdivides into 5 waves, irrespective of what time frame you're dealing with. So whether it's a daily time frame, weekly, monthly, quarterly, whatever time frame you may be dealing with, the market subdivides into 5 waves. And similarly, when it enters a bear market, it subdivides in 3 waves. This is just broadly speaking the theory. Now there are of course rules and guidelines to how that 5 wave develops, but that's sort of what Ralph Nelson Elliott, the author of the entire work, which is the wave principle that he put together, explains to us. And we've, of course, users of it over time have found that this pattern is repetitive, and so there have been many users and publishers on the theory. So no shortage of it being time tested in real market analysis. But the other interesting gentleman, like I said, is Nikolai Kondratev, the Russian economist. And he ended up studying economic cycles. He ended up looking at various economies, saw them from inception to boom to bust, and tried to figure out what exactly happened between each of these boom bust cycles. And he found that after this boom bust cycle, there was another boom bust cycle, and each cycle lasting for several decades. And so essentially what it all came down to is that this was nothing but a financial cycle of the expansion and contraction of money. So any economy, say for example, when it's at its inception or very, very early stages of growth, or if it starts from zero. Now, when does an economy really start from zero? You can take the best example as India going through its own independence movement. And once India becomes independent, business is at its lowest point and then starts expanding, right? So at that point of time, money in circulation is usually limited. The amount that is printed as a percentage of total GDP will usually be a small ratio. But as an economy keeps expanding, the amount of money in the economy also expands over a period of time. So it could start at 10-15% of GDP, become 20, 25, 30, 35. And we measure this money not just as the actual currency, physical paper in circulation, but also in the modern world, we know that we borrow money, we lend money, we do it through the banking and financial system. And so you end up measuring all the loans and debt that is outstanding. So we look at total credit in the system that is there and measure it as a percentage of GDP. So it will start at a very low point. It may start at, like I said, 10, 20, 25%, expands over a period of 2-3 decades, 30, 35, 50. And then maybe over 50, 80, or maybe even 100 years, it could end up crossing 100%. Now, once it does that, once you've reached that extreme point, is when you can't really handle economic growth anymore. There's so much debt in the system or credit in the system. Somebody's got to pay it back, and then that payment back is so the cost of paying it back essentially bears down on the potential growth that you can have once you've crossed that point. Now, there have been studies that show that it's not exactly 100. I mean, 100% is like a rough level above which problems can start. It can start at 100, 120, 150. So there's no fixed level at which it starts. It's just a highlight that economic growth can hit a wall once you've reached that point. But between 0 and 100, there's a long phase. This phase was studied to be approximately, like I said, 50 years. But what I found in the recent studies, because US has actually gone through this cycle now almost 100 years now, I think, and same with India as well. And the reason for that is there are other things that interact with these cycles, which are, so you have finance on the one side, but you also have technology, right? You have technology developing on the sidelines, and if you have very good technological progress, then that can sort of extend the economic growth cycle for a period of time. And the third and most important factor can actually end up being demographics. So if you have good demographics and expanding population, a young population that will grow up and then enter its middle ages, spend, buy houses, travel, and so all of that creates growth through various offspring, and that itself adds to the length of the cycles. How long we actually live. So I would think that one of the things seriously impacting the length, because too many people obsess with time, that a cycle is supposed to end in 50 years or 70 years or 90 years. But time is varied. It doesn't have to be fixed. And it's expanding or contracting because of demographics or the longevity, which means are we living longer, healthcare is improved, and we have technological progress. So both of these have helped these cycles extend longer than they did in the past studies, which is partly why such studies were, often left behind even after having been put in these technical texts. People thought, oh well, if it's gone beyond 50 years, maybe it doesn't work. But the real thing, the real juice in it was not the time factor, but the series of events that follow one after the other. So these series of events were described by Nikolai Kondratyv as the seasons. So which is why on the right hand side of this chart, what you see is seasons, and on the left hand side you see are the wave counts. So wave counts are telling us that yes, if you have a long 50-year, 100-year bull market, it's supposed to subdivide in 5 waves. And then it may have an ABC bear market. Whereas the economic cycle tells us that the spring, which starts from the bottom, can go on for 30, 40, 50 years, is a phase when you have expanding credit, which eventually leads to growth, and the growth eventually leads to inflation. And so this growth goes on and on and on for a long period of time. And at the beginning of that phase, because you want to stimulate growth, you may have very, very low interest rates. Okay, so now to understand this whole perspective, I'm going to use a pen so I can actually highlight. This is the bottom end, right, where we start with very low interest rates because the debt level in the economy is very, very low. You want people to borrow more and spend, and so that there's growth. So you keep rates low for a prolonged period of time till growth really picks up. And then as growth picks up, you get inflation. As you get inflation, interest rates are raised. And there's still a time when, the debt ratios or the credit ratios in the economy are not very, very high. So even though you're raising rates and there's inflation, it's not much of an issue. Okay. The only time it becomes an issue is, yes, inflation rises and ends up being double digits. And then it's like, now we got to stop this. And you end up getting the summer. So you get a summer where interest rates have to be raised significantly to bring down the rate of inflation. So now you get inflation dropping, and then you get interest rates dropping after that. So you had a period of growth. The high interest rates here in the summer don't really bother much because the credit level is not so high. It may be 50%, for example, of GDP. And so nobody cares. Even if you raise interest rates to 15%, 20%, slows down the economy a bit. And the good part is once you get inflation and interest rates under control, so inflation comes down, then interest rates come down, and then you get a feeling of, I've got everything under control. The government feels like most satisfied at the end of the summer that